Welcome to this week's series of Credent Connect. And as you'll see, slightly different setup this time around. Alisha and I are not in our regular recording studio, but we are going to do this over Zoom because what has materialized in the markets and just broader economy here thus far in 2026, especially through here near the end of February, has resulted in this narrative, in this performance profile across various markets that has spanned a wide array of individual stocks. The expansion, the breadth, the coverage, this kind of slow rotation component. And one of the things we wanted to do today is truly focus and actually showcase to you what we mean when we talk about things like this broadening of performance and how has that actually materialized, right? So Alisha, as I pull that up, maybe give us an overview of breadth, widening breadth. Like, what does that even mean when we use the term widening breadth in the markets? Because I feel like we use it often. There's maybe a definition to that as I pull this chart up.
Yeah, so what that means is looking at the sectors or the stocks within a particular sector that is working well. So what we have found over the past couple of years is that breadth was relatively narrow. We were seeing that the Magnificent Seven, so really focused on things like technology, things like consumer discretionary or communications, really led the market. When we talk about breadth, what we're seeing are other sectors are starting to participate, and particularly within more of the value-oriented space.
Yeah.
So things like energy, things like materials, we're starting to see that rotation out of some of those tech names into more of those value-oriented sectors.
Yeah, great point. Year to date, when I say year to date, through February 24th in this case, the energy sector is up substantially, roughly 23% so far year to date. And we have the financial sector down roughly 7%. That's a 30% differential in that spread, which is one of the widest we have ever seen sector to sector in the S&P. So to that point, that widening is quite tremendous. So here's what's been fascinating. And, we talked about this last time, and here we can actually showcase it with data. And what you're seeing on your screen is what we call a normalized performance chart. And all it means is that it tracks the percentage change of each index so far throughout the year. And this white line here, that is the S&P 500. And the way to interpret this value of 100.81 is essentially 81 basis points or 0.81%, meaning so far year to date, the S&P 500 is up just call it close to 1% in total return. What's been fascinating in that widening exposure is those other three lines above. That purple line, which is the equal weighted S&P 500, the yellow line, which is U.S. small cap stocks, and that orange line, which is U.S. mid cap stocks. They are outperforming the S&P 500 by a factor of 6, 8, and 9% just year to date. And the main reason for that is at the very bottom there's a dark orange line here, and that is the S&P 500 Information Technology Index, tech stocks, which are down on a broad basis, roughly 4 to 5% year to date. So when Alisha's talking about breadth and the definition of it, to us, this is the quantifiable approach to saying, how has that breadth materialized? This is so critical because in our approach, and Alisha, I'm going to maybe have you expand on this just for maybe 20, 30 seconds. In our approach of diversification, we have defined processes in how we invest in large caps, mid caps, small caps. Give us that overview as of today, how we're largely allocated within large caps, whether it's value or growth, and then do we have any mid cap, small cap exposure? Because we're never going to be only betting on one horse in that race. We are a very intentionally structured. Maybe give us that maybe 30-second overview.
Yeah, so we are invested across the market cap spectrum. So when we look in the large cap space, we do have a little bit of an overweight to growth, but that has narrowed, and we are focusing and shifting sector-wise into some more value-oriented sectors. Now, on the mid and small cap, we're sitting around 15 to 16% of our equity portfolios in mid and small caps, and we do that in a very diligent way. We had anticipated some of this broadening happening, and so we have shifted some into mid and small. And the way that we're doing that is through individual stock selection. So we're looking for companies within mid and small cap spaces that are profitable and growing in their profitability, that have decent looking valuations, and that are have the ability to generate strong cash flow, so they have optionality. So definitely across the board, we have exposure across style classes as well as across the market cap spectrum, across all of our diversified portfolios.
Yeah. And we're going to continue pushing the kind of analytical ability of the process there to gauge at what point do we want to actually shift more away from the S&P and more into those other components. And one of the ways we're actually looking into that is by just tracking the bond market. What's happening in bonds? I know this may sound silly, but the bond market can actually be one of the best ways to tell us what to do with the stock market. They tend to drive each other from a credit risk standpoint. And what you're seeing here in front of your screen right now is yields, right? Maybe you've heard the term yield curve before. Well, this is the yield curve of the U.S. Treasury market. And that blue teal looking line, that was the yield curve from 1 year ago. And that white line is the yield curve today. So what you have seen is when the yield curve in this context, when the yield curve today rather, is lower than the yield curve from a year ago. And when it's steeper on the long end, because on the x-axis there, the left side is something like a 3-month treasury, the very far right side is something like a 30-year treasury and what their annualized yield is. When you see that steepening, there tends to be a better expected backdrop of economic function, economic activity over the long term, meaning somebody is incentivized, an investor is incentivized to purchase that 30-year treasury, that's how the market views it, as a result of what may transpire in the economy, whether it's growth-based, whether it's very low probability of economic downturn and recession-based. It signals a very healthy approach. And to us, in the allocation process, and why we've been preaching this breadth concept over the past 12 months, and how it's actually materializing now, is a very, very intentional approach to how we manage assets here at Credent Wealth. So we'll leave it at that. This is a mini education of Credent Connect for us, a different approach, and hopefully there is a lot of merit to it, because if so, we will continue to do these, and looking forward to keeping you apprised of how we make decisions. Thank you.